Hi there, my name's Kent Kramer. I'm the Chief Investment Officer at Foster Group. And if you've been paying any attention at all to financial markets or just the news in general, you've probably been hearing a lot about a store called GameStop, or affectionately referred to as GameStonk if you saw the tweet by Elon Musk. So why has this company been in the news so much? Well, it seems like some hedge funds took some very large short positions in GameStop. Basically, they were betting that the company stock was going to decline, but some clever traders on a Reddit forum called Wall Street Bets saw what the hedge funds were doing and they thought, hey, wouldn't it be fun to kind of stick it to the smart money with a lot of retail investors to see if we could cause that short bet that those hedge funds were making against GameStop as a company and against the GameStop stock? What if we cause them to maybe lose some money instead of making some money? So how does that work? Well, let's take a quick primer on short selling because it's kind of an esoteric thing. Some people don't know as much on how it works. But here's just a simple example. Let's say that Jenny owns 1,000 shares of ABC Incorporated, and Forrest wants to short sell that ABC company stock. So Forrest has to go out and he has to borrow the shares from Jenny so that he can sell them to someone else. As soon as he borrows those shares and then sells them to someone else, he's now short 1,000 shares because he's going to have to return the 1,000 shares that he borrowed from Jenny to her at some point in the future. Now he's borrowing those 1,000 shares so he can sell them. So Forrest sells 1,000 shares. Let's say he sells them at 15 bucks. So he takes in a cash flow of $15,000, but remember he still owes the 1,000 shares to Jenny. So he's kind of in a net zero position on that particular day. Now, 120 days later, let's say ABC company is trading at $10 instead of 15. So Forrest goes out and he buys back 1,000 shares of ABC company for $10,000. Now he's to the good 5,000. He had a net liability of these 1,000 shares back to Jenny, but he's bought back the shares for less than he kind of received when he sold them. So he's now 5,000 ahead. On that same day, he returns those 1,000 shares to Jenny that he borrowed, and he has to pay her some interest as well for the privilege of borrowing the shares for however long he was going to hold them. So at the end of the day, let's say he has to pay $200 in interest on those $1,000 shares or those 1,000 shares that he held. He's basically ahead $4,800. And that seems like kind of an interesting strategy, but it's a way that people will try to make money off stock prices that are falling instead of rising. So what does this mean for our story with GameStop? Well, what if you're a hedge fund or maybe a group of hedge funds and some large investors and you start taking some short positions in very, very large numbers? And this is a story of short selling gone very, very bad. So GameStop has about 65 million shares of stock outstanding. And what happened is a group of hedge funds and other investors were shorting the stock. In other words, they were borrowing the stock in order to sell it. And they ended up shorting over 140% of the outstanding shares. In other words, not only were they short the 65 million, but because some people can borrow them and then sell them, and those people they sell them to can also lend them out so other people can sell them. So what happened is there was 140%, or about 91 million shares, it seems like, that were shorted against 65 million of actual shares outstanding. Now, if you're following the math at all, and I know it's convoluted, let's say that all those people who borrowed those shares, and we don't know this is just a hypothetical example, but it seems like it's going in the right direction. Let's say that they sold all 91 million shares at $20 a share, which is about where the price was 30, 40 days ago. That would have brought in $1.82 billion in proceeds from the sale. Their net position is zero because they still have to return those shares at some point in the future. But on day 120 or at some point in the future, what if GameStop's price, instead of going down like the hedge funds were hoping, went up and went up a lot, like was happening with Reddit and the Wall Street Bets forum trying to do? Well, today, that stock is traded as in the upper 330s. We'll look at it here in a minute. But what that would mean is if those hedge funds needed to close out their positions today, they would have to go out and buy 91 million shares at $330 a share, which would cost them over $30 billion, leaving them in a net position of losing $28 billion. That really is sticking it to the smart money if that's how you think of hedge funds. They've got to return those shares with interest to the people they borrow them from. So by the time they pay interest, maybe another 24 million, all of a sudden they're down over again $28 billion trying to close out this position that they were just shorting one very, very small company in the US stock market. Basically, at the end of the day, that's a big ouch for a hedge fund. And it seems like maybe a big win for small investors, but really, is it? So let's take a look here at what's happening with the actual shares of GameStop. So here's what's happening with GameStop today. And when I put this up, I wanted to be able to see really what's happened in the last month. And it just describes the story. Here you can see this SMA, this simple moving average. It just shows the average share price over the last 200 days has been about 15 bucks. Over the last 50 days, because the share prices have been rising, that simple moving average share price has risen to about 40 bucks. Now, what happens is all along the way here, when those hedge fund traders were borrowing the shares and reselling, probably somewhere between 15 and 40, the people at Reddit and Wall Street Bets in particular, they got involved and they started bidding the price up. That's what these candlestick lines are here. You can see the price is rising. This red line was yesterday's price. This is when we had all the problems at Robinhood when they closed their trading. But you can see the trading range was enormous from the 480s all the way down to 260, I'm sorry, to 112. I mean, it was a big volatile trading range, and that was because some of those brokerage platforms were actually stopping trading at times, causing a lot of pricing issues. Today, they've allowed a little bit more trading, but you can see down here the pictures of volume. These blue bars represent trading volume in the day. So you can see in the back here in early January, no one was paying any attention to GameStop. There weren't a lot of shares being traded. All of a sudden, there got some interest on that message board, and then things really blew up with volume. Yesterday, the volume retreated because it was halted at times, and today you can see the volume beginning to take off again. But the price of the shares are really high. Again, we're trading at 328 right now. This is a live picture of the stock. So if the hedge funds or people who were shorting originally sold at that kind of $20 price point, down here, the moving average, they would literally be underwater tens of billions of dollars. So what are the GameStop buyers, the people who are kind of sticking it to the hedge funds, what are they actually getting as a result of this? Well, they do get to stick it to the smart money, right? They've had some success in watching this thing go up, and those people who had short sold, they were put in a bad spot. However, you need to remember this is really, really short-term speculation. What's happening here is all these people who are right now buying GameStop, they're buying it with the idea that somebody else is going to be there right behind it to buy it at a higher price. So it's a very, very short-term speculation pattern, very, very different from a long-term investor in terms of how they think about participating in the market. I would describe this almost like speculating in a commodity or something even like art or a baseball card. A thing is only worth what somebody else is willing to pay for it. So what happens is I buy it for X, hoping that you're going to buy it for X plus one. And as long as there's other buyers in the market, that's great. But it's kind of like a game of musical chairs. As soon as people stop buying, that price of GameStop is going to go back down closer to probably its fundamental value, which looked to be somewhere between $15 and $30. If you look at kind of what the investment traders were buying and selling that stock for just as recently as 20 and 30 days ago. So long-term investors are faced with a choice here. They can either say, wow, this stock went way higher in terms of price than I ever thought it would go, so I'm going to sell and just take that 330 and go away. Or you can just kind of choose to ignore the noise and say, you know, I'm a long-term investor. This is a lot of noise. I'm not sure if it's worth buying or selling in the midst of all this volatility. I'll just hold it through, and 5 or 10 years from now, along with my rest of my portfolio, I expect things to have increased in value, and my portfolio should do what I was really expecting it to do as a long-term investor. This is a good example of really knowing which game you're playing and playing in that way. Morgan Housel says it really well in his book, The Psychology of Money, when he talks about two different games and two different kinds of people participating in markets. One is the speculators. They are looking at a very short-term game. What can I buy today and sell maybe later today or tomorrow, versus a long-term investor who's looking to buy something today and hold it for many years. And you can see Housel's quote here: bubbles do their damage, these inflated stock prices, when long-term investors playing one game start taking their cues from those short-term traders playing another. It's really important to remember what game you're playing. These stories in the news like Reddit, Wall Street Bets, and GameStop are super interesting, but they might not be the game that you want to play. If you have any more questions or you'd like to meet with a Foster Group advisor, we hope you'll contact us. We've given you some information here on the screen. Thanks for tuning in today. We'll see you soon.